Another year in the books, and what a crazy year it has been. I think we can all agree that it was an extremely educational trading year, not only for beginners, but also, and even more so, for veteran traders, as we've really never seen a market like this. So in this video, I'd like to talk about our trading results this year, but more importantly, what we can learn from our experiences. So you're looking at my trading account right now. You can see I'm up $84,500 on the year, and the current account value is just over $198,000. This account started the year with a $115,000 balance, so really after fees we're up around $83,000. Now, an $83,000 profit on a $115,000 account is around a 72.5% return on capital. We navigated the markets beautifully this year. If you look at the S&P 500, it's up 15.5% on the year, and my account is up 72.4% on the year. To take this a step further, the S&P 500 is up 70% from the very bottom tick. So we've performed better than if we were to go all in at the very bottom tick and just held stocks as they scream to the upside. And as you guys know, timing the market that perfectly with your entire account is nearly impossible to do. So how did we do this? How did we perform this well this year despite everything that happened? Well, it all boils down to one simple thing. I adapted to the changing markets, and I did so without hesitation. Look, here's the thing. There's not one trading strategy that works 100% of the time in every market environment, at least not to any magnitude. It just does not exist. The fact is, markets change, and as they do, it's your job to adapt. Good traders realize the key to successful trading is being forward-looking, adapting to the changing markets, and doing so quickly and intuitively. Good traders don't just trade one strategy 100% of the time. On the other hand, poor or even average traders only look backwards at past data. And because of this, they either don't adapt or are very slow to adapt. And they only trade one strategy that doesn't ever evolve with the market. Most of you already know that the core of our trading strategy involves selling option premium on a regular basis. In fact, we've been selling naked option premium on the S&P futures market for years. Well, it doesn't take a genius to realize that being short naked options during the crash probably didn't perform that well. That's like selling car insurance to someone right before they go out and total their new car. And we actually were short futures options before the crash started, but it was obvious to us that we were in a very unique and different market environment than we've ever seen, as the VIX exploded to almost 50 in just a few days. So we actually closed our short futures options at the very start of the crash for a small loss. Now, backtesting through historical markets would suggest that we should not have cut that loss, and we usually wouldn't have. But this year we weren't trading through historical markets, we were making history, which means we may have to trade it differently than we might have in the past. The point is, that decision to close that trade and significantly cut down our risk was a forward-looking decision. We were looking at the new market environment we were in. We weren't looking back at chart patterns and historical data to make that decision. Now, let's fast forward a bit because how we've traded after the crash is equally as important. Near the bottom, when everyone was still extremely fearful, I started buying up shares of tech stocks. I started buying companies like Nvidia, AMD, Logitech, Amazon, and Apple. I also started selling put options on airlines and casinos and other stocks that had been hit the hardest by the idea of everyone having to stay home. You see, I adapted. My approach at the start of the year was largely focused on selling futures options in the S&P 500 index with a neutral bias on the market. But then my approach shifted massively to selling expensive put options on the non-stay-at-home stocks and buying up all of the stocks in the tech and the gaming industry, because that's where the opportunity shifted. You see, sometimes trading and investing is less about being scientific and more about being opportunistic. And of course, as the market rallied, people could not believe it. They couldn't wrap their heads around how the market could possibly go up, even though the state of the economy was not improving yet. But again, the market was forward-looking, so if you weren't, then you probably got left behind. And the fact that everyone was so confused by the rally was even more reason to, number one, continue letting these positions run, and number two, continue putting on even more bullish positions, even though the market had already rallied quite a bit. Now, those of you who've followed us for some time know that getting bullish into strength is not really my style. But because I was looking forward, I didn't care that the stocks had already rallied. Now, obviously, it's easy to see why this was a good approach in hindsight, but we did it in real time, and that's what matters. The bottom line is, you have to think differently. I think it was Warren Buffett who said, "Be fearful when others are greedy, and greedy when others are fearful." This is the approach I've taken this year, and it's because of this that I was able to perform so well despite trading in a market that felt extremely foreign to everyone. Now, don't get me wrong, I'm not saying I'm a perfect trader and never make mistakes. Every trader makes mistakes. I certainly made a few this year as well. But consistently successful traders make less of them. So, alright guys, hope you enjoyed the video. If you did, make sure to click the like and subscribe button below. And also, be sure to check out our 3 free video series by clicking the link in the video description below. These videos will help your trading tremendously, and they are completely free. All you have to do is click the link, input your email, and we will send you the 3 videos. So, I will see you there.